Have you ever wondered about the current state of New York Community Bancorp shares? Today, we're delving into the unexpected and shocking plunge in the shares of New York Community Bancorp, or NYCB, a significant player in the banking sector. In a surprising turn of events, NYCB's shares plummeted by more than 40%, a dive that briefly took them below their intraday low since March of 2023. This sudden drop is not just a record low for NYCB, but it also stands out as one of the most significant single-day declines in its history. But what's even more intriguing is that the aftershock of this plunge rippled through the banking industry, nudging the shares of other banks. Valley National Bancorp, Western Alliance Bancorp, and Comerica all experienced a drop in their shares, ranging from 3 to 5%. This wave of falling shares paints a vivid picture of the interconnectedness of our banking sector. The event that triggered this plunge? Well, NYCB announced that it had shifted to a stricter regulatory category following its acquisition of the collapsed depository, Signature Bank. Moreover, NYCB, which had earlier purchased some of Signature Bank's assets, reported a massive dividend cut of 70%. This was accompanied by a decision to raise capital, a move aimed at bolstering its balance sheet. The combination of these factors, it seems, sent investors into a frenzy, leading to the drastic sell-off that we're discussing today. In the midst of all this upheaval, it's worth noting that NYCB's plunge is a stark reminder of the inherent volatility and risks in the banking sector. It underscores the importance of robust regulatory systems and the role they play in maintaining investor confidence. The big question now is, what lies ahead for NYCB? How will it navigate through this storm, and what measures will it take to restore investor confidence? One might ask, what led to this drastic fall? Well, let's take a closer look in the next few scenes. Stay with us as we unravel the story behind New York Community Bancorp's dramatic plunge in shares. The answer lies in an acquisition, a key turning point for NYCB. In a twist of events, NYCB found itself in a position to acquire the collapsed depository, Signature Bank. This acquisition was not just about taking over assets and liabilities. It was a strategic move, a gamble if you will, that would either boost the bank's standing or send it spiraling into a financial abyss. Signature Bank, once a thriving financial institution, found itself on shaky ground, its stability compromised. When it collapsed, NYCB saw an opportunity and swooped in. The bank bought some of Signature Bank's assets, hoping to bolster its own financial standing. But this move was not without its challenges. The acquisition shifted NYCB to a stricter regulatory category. Now that might sound like financial jargon, but let's break it down. In simpler terms, it meant that NYCB was now subject to more stringent regulatory oversight. The bank had to maintain higher capital levels, undergo more frequent stress tests, and implement more robust risk management systems. These measures are put in place to prevent a financial institution from collapsing, but they come with their own set of financial implications. This regulatory shift put a strain on NYCB's financial health. The bank was now obliged to maintain more capital, which meant less money available for other investments and operations. This pressure to comply with stricter regulations, coupled with the costs of acquiring Signature Bank's assets, put a significant dent in NYCB's finances. The acquisition was a double-edged sword. On one hand, it provided NYCB with an opportunity to expand its asset base and potentially increase its market share. On the other hand, the regulatory implications and financial strain of the acquisition became a significant burden on the bank's bottom line. Every acquisition has its risks and rewards. For NYCB, the acquisition of Signature Bank was a calculated risk that brought about considerable financial strain. The move to a stricter regulatory category meant the bank had to toe the line, facing greater scrutiny and bearing higher costs. Now let's delve into the fallout of this acquisition. The acquisition of Signature Bank was followed by a series of unsettling announcements. A crescendo of concern began to build amongst investors when New York Community Bancorp, having just taken over the assets of the collapsed Signature Bank, suddenly reported it was slashing its dividend by a staggering 70%. This dramatic cut was a shockwave that sent ripples through the financial community. But there was more. The bank also declared it was raising capital, a move generally interpreted as a measure to shore up its balance sheet. In the financial world, such a decision is often seen as a red flag, an indication that a company is facing financial distress. It's a bit like a homeowner suddenly deciding to sell off their furniture. It might give them a quick cash injection, but it's not a sustainable solution, and it certainly doesn't inspire confidence. Consequently, the impact on investor sentiment was swift and severe. The bank's share price, already in freefall following the acquisition of Signature Bank, plummeted even further. The market's reaction was emphatic, a clear vote of no confidence. The bank's shares didn't just slip or slide, they plunged, diving more than 40% and even trading below an intraday low last seen in March 2023. This drastic fall wasn't confined to New York Community Bancorp either. The tremors were felt across the banking sector, with shares of Valley National Bancorp, Western Alliance Bancorp, and Comerica all falling between 3 to 5%. It was like a row of dominoes toppling, one financial institution after another, all reeling from the shockwaves sent out by New York Community Bancorp's unexpected announcements. And so we find ourselves in a situation where trust in traditional banking institutions seems to be eroding. The financial landscape is shifting beneath our feet, and it's not clear what the future holds. And this begs the question, could there be a potential solution to these bank failures? In the face of such turmoil, could Bitcoin be the silver lining? As we delve into the heart of the financial storm that has rocked New York Community Bancorp, we've seen shares plunge, dividends cut, and unexpected losses. Now, we turn our gaze towards the horizon where a glimmer of hope might just be emerging: Bitcoin. This digital currency, often referred to as cryptocurrency, has been making waves in the financial world. It operates independently of a central bank and uses encryption techniques to regulate the generation of units of currency and verify the transfer of funds. Bitcoin's rise in popularity has been nothing short of meteoric. From being virtually unknown a decade ago, it has now become a household name. Its value has surged and its acceptance has grown, not just among individual investors, but also businesses and even some governments. Could this digital currency be the magic bullet that struggling banks need? Could Bitcoin help banks like NYCB recover? Bitcoin, with its decentralized nature, could potentially provide a solution to bank failures. In a world of Bitcoin, there are no bailouts, no dividend cuts, no unexpected losses. Bitcoin exists outside the traditional banking system, and therefore it is not subject to the same risks. Moreover, Bitcoin can also provide a new way for banks to raise capital. Instead of relying on traditional means such as issuing shares or bonds, banks could potentially issue their own digital currencies or tokens. This could provide them with a new source of funding and a way to attract a new generation of tech-savvy investors. However, it's important to remember that while Bitcoin holds promise, it also comes with its own set of risks. Its value can be highly volatile, and it has been associated with various illegal activities due to its anonymous nature. While it's too early to tell, the possibility is intriguing. It's a potential solution that warrants a closer look. As we navigate through these turbulent financial waters, Bitcoin might just be the beacon of hope that guides us to safer shores. So, what have we learned from the saga of New York Community Bancorp? The recent trajectory of New York Community Bancorp has been a roller coaster ride that has left investors and market watchers on the edge of their seats. From the acquisition of Signature Bank to the sharp fall in share prices, the story of NYCB is a vivid illustration of the volatile nature of the banking sector. Firstly, let's revisit the acquisition of Signature Bank. NYCB's decision to buy the assets of Signature Bank, a collapsed depository, was a bold move that held promise. However, it also led to NYCB moving into a stricter regulatory category, a development that shocked many and contributed to the sharp decline in the bank's share prices. Then came the announcement that sent shockwaves through the market. NYCB was cutting its dividend by a staggering 70%. This, coupled with a move to raise capital to shore up its balance sheet, was a clear signal that all was not well in the house of NYCB. But the drama didn't end there. In a surprising turn of events, the bank reported an unexpected loss. This was a blow that further fueled the downward spiral of the bank's shares, leading to them trading below an intraday low since March of 2023. In the midst of all this turmoil, an intriguing question has emerged. Could Bitcoin be a potential solution to the ongoing bank failures? While it's too early to draw any conclusions, the rise of digital currencies is certainly a development that cannot be ignored. While the future remains uncertain, it's clear that banking institutions like NYCB must evolve to survive in this rapidly changing financial landscape. The saga of NYCB serves as a stark reminder of the challenges facing the banking sector, but also the opportunities for innovation and transformation that lie ahead.